Hi everybody, this is lecture for week 8, supposed to be on Tuesday 14, today, Wednesday 16th of December. Okay, and this one supposed to be topic number 8, pricing and profitability analysis. Okay, let's see. A manager has to make many business decisions. One of the most important decisions is to make pricing decision. Let's say a business produces a product. Then the most important thing is the manager has to decide what is the price for the product. When the manager want to decide for the price of the product, the manager has to have a focus to maximize profit or to maximize the market share or to beat the competitors, etc. But the main point is pricing decision is very important. The price of a product is very important. It will determine whether the business can survive and perform well or not. Okay, let's see. What are the major influences on pricing decisions? When the manager want to make a decision about the price of a product, there are many factors that the manager has to consider. These factors can influence the pricing decision. So the first one, customer demand. Customer demand, most of the time, if the demand for a product is high, then the manager or the business can set the price a bit high. If the demand is low, then very difficult to set a high price for a product. And then political, legal, and image issues also can influence the pricing decision. Cost is another most important thing. If the cost is high, if the cost to produce a product is high, then the price for the product will be high. If the cost is low, so the manager or the business can set the price low. And the next thing is competitors. Competitors is also very important. If the product has many competitors, if a product has many competing products, the same product produces by many companies. So in a situation like that, most of the time a price cannot be manipulated. In a market where there are many competitors, very difficult to manipulate the price, because everybody will try to set maybe a low product, so profit is very thin. So if the competitors are not many, like in a monopoly market, so then a business can set high price. If the market is like free market, there are many competitors, then very difficult to set a high price. Okay, price elasticity. Price elasticity is the impact of price changes on sales volume. You have learned this term in economics, the price elasticity, demand elasticity. So if demand is elastic, if a price increase, very difficult to read this one. Okay, demand is elastic if a price increase has large negative impact on sales volume. If a small increase in price causes big impact on sales, then the price is the price is elastic. If demand is inelastic, if a price increase has little or no impact on sales volume. So if the increase or the changes in price has a very small effect on sales volume, then that situation we call it inelastic or less elastic. Price elasticity. Okay, now in this chapter you will learn about how to set the price or how to make pricing decision. Okay, how prices set? Prices are determined by the market, subject to cost, and must be covered in the long run. Prices are based on cost, subject to reactions of customers and competitors. So the thing that this slide want to explain is the pricing decision or the price of a product is influenced by the cost and market forces. The higher the cost, most of the time the higher the price. And also sometimes even though the product cost is low, when the market is less competitive, the price of the product can be high too. In a market where there is low competitive, in that market we call it monopoly market. So in that market, if a business produces something and the price for the cost for the product is low, still the company can sell the product at higher price because there are no competitors. So the main thing that the slide want to explain is the price of a product is or can be influenced by the cost and also the market forces. Okay, so now economic pricing concepts. So I think you have learned this in year 1 or something. I believe you have taken several economics courses. So like the thing that you have learned in economics, price is determined by the supply and demand. So I think you know this. The higher the demand, the higher the price. Oh, something wrong with this maybe. Supposed to be the higher the demand, the higher the price. And also, the higher the supply, the lower the price. The higher the supply, the lower the price. I don't know whether this is correct or not. The higher the demand, the higher the price. Quantity of demand. And then the higher the supply, the lower the price. But I think you can still remember about this. Okay, this is about the market. I hope you still can remember this. There are many, there are different type of market for a product. In a perfect competition market, there are many buyers and sellers, no one of which is large enough to influence the market. I think in Malaysia, the simple example is the market for cooking oil, minyak sawit oil. There are many brands, and also so there are no one company large enough to influence the market. There are many companies, there are many brands, Visa with Alif cooking oil. There are many, so they cannot control the market. Everybody is not large enough to influence the market. So the price is very almost similar. That is one type of market. The second type of market is monopolistic competition. Has both the characteristic of both monopoly and perfect competition. I think there are several big companies for this market. Oligopoly, there are few sellers, and monopoly. Barriers to entry are so high that there is only one firm in the market. So in a monopoly market, it's like now very difficult to see a monopoly market because the government does not like the monopoly company. Always there are competitors. Like many years ago, we have only one airline, Malaysian Airlines, one airlines. But after several years, we have AirAsia, Malindo Air, and etc. Because to allow competition. When there are competition, the price will become lower and the service most of the time will become better. Okay, so let's see here. Market structure type, number of firms in the industry, barriers of entry, uniqueness of product, expenses related to structure type. Okay, let's see here. Market structure, perfect competition. Number of firms in the industry, there are many firms. The barriers to entry is very low. Uniqueness of product is not unique. Expenses related to structure type, there are no special expenses. The thing that I can think is the market for cooking oil in Malaysia. There are many sellers, there are many brands. Easy to entry. Anybody can sell the cooking oil, the minyak sawit. And the product are not unique. The products are same. The bottle are almost same, just the brands are different. And then no special expenses related to the this market. Okay, now the second type of market is monopolistic competition. Many firms in the industry or many companies, the barriers to entry is low. Uniqueness of product, there are some unique features. Expenses related to the structure type is advertising, coupons, cost of differentiation. Oligopoly, few firms, very high cost of entry, fairly unique cost of differentiation. Uniqueness of product is fairly unique. Cost of differentiation, advertising, rebates, and coupon. Okay, now I think the thing is like this. You see the market structure type. Market structure type, the first one is perfect competition. Okay, that is almost a free market. Okay, and then the lower the number 2 is still many companies, less competition. Oligopoly, less competition, and monopoly is zero competition, only one company or one firm. Okay, so that is the way this table show you the difference of the market. And then see the monopoly, only one firm or company. The barriers of entry very high. Product is very unique. Legal, the expenses related to structure or type is legal and lobbying expenditures. Many years ago, we have several monopoly market, monopoly company. I think the one now we still have things company like TNB. TNB is a monopoly company. but uh, it is controlled by government. If government does not control TNB, TNB will set a very high price maybe for electricity, because they want to maximize their profit. But then we have TNB, but it is controlled by government. Sometimes government subsidize the electricity. Telecom Indonesia is also a monopoly company many years ago. Now we have many several, I think, telecommunication companies. Okay, so different market is associated with different pricing strategy. Okay, according to this slide, there are two approaches to pricing. It means that if you in the future working as a manager or you are a management accountant in a company, you have to aware that there are two methods that can be used to set price for a product. The first method of approach is cost-based prices. You set the price by referring to the cost. The second approach is target prices. For this method, the price of a product is influenced by the market condition. Okay, let's see one by one. We see the cost-based price first. Cost-based pricing approach. Cost and pricing policies. Okay, first, cost plus pricing. This is one method. For the cost plus pricing, markup is a percentage applied to base cost. It includes desired profit and any cost not included in the base cost. Okay, now we have a formula here. Markup on COGS, cost of goods sold, equal to selling and admin expenses plus operating income divided by cost of goods sold. Markup on DM equal to direct labor plus overhead plus selling and admin expenses plus operating income divided by direct material. What is this? Markup on direct material maybe. DM is direct material. Okay, this is an example. Very easy to see the way to set the price using or by seeing this example. Let's see. Audio Pro company sells and installs audio equipment in home, cars, and trucks. Audio Pro's income statement for last year is as follows. Revenues 350,350, cost of goods sold, total cost of goods sold, let's see, 245,000. So gross profit is 105350. Selling and admin expenses 25,000. So operating profit or income is the 80,350. So let's see. The firm wants to earn the same amount of profit on each job as was earned last year. So I hope this is a good example. Markup on cost of goods sold. Selling and admin expenses plus income. So the calculation is you use this formula. 25,000 for selling and admin expenses plus the income is 80,350 divided by the cost of goods sold 245,000. So the answer is 43%. So this method is markup on COGS. So if there is a question ask you if the firm wants to earn the same amount of profit on each job as was as was earned last year. So you can use the markup on COGS method. The percentage is 43%. The markup can be calculated using a variety of bases. The calculation for the markup on direct material is as follows. So this is the markup on DM method. Direct labor plus overhead plus selling and admin expense divided by direct material. So if we use markup on DM, the number is 1.86 or 186%. So remember, very easy. Cost plus pricing is like you calculate the price or you set the price according to the cost. How many percent from the cost. Okay, see here. Audio Pro wants to expand the company's product line to include automobile alarm system and electronic car door openers. The cost for the sale and installation of one electronic remote car and one electronic remote car door opener is as follows. So the business want to introduce new product. So direct material $40, direct labor $30, overhead is 60% of the direct labor cost, so $19.50. So estimated cost for one job is $89.50. So if the company want to get the same percentage of profit like the previous year, so the business has to use 43% markup on COGS. So if you use that 43%, then 43% times the $89.50, you will get $38.49. So the price, the bid price for this electronic remote car door opener is $127.99. Okay, so this is the end for this first lecture. Do not forget to write your name and metric number in the comment section so that because I will take it as the attendance. Thank you very much.